Good evening once again. Yes, in our last class, I introduced you to capital budgeting. We talked about the introduction to capital investments. Uh, we also discussed the procedures involved in capital budgeting decision. All right. Then thereafter, we proceeded to discussing, we talked briefly about the characteristics of capital budgeting. Then we proceeded to discussing the project evaluation method. So under that, we'll talk about discounted as well as the non-discounted cash flow methods. And we under each of the two, we mentioned that under the discounted cash flow method, we have a net present value techniques. We have internal rate of return. We also talked about the modified internal rate of return. We talked about project duration. Then, of course, we talked about discounted payback period. So we then move to we then move to discussing the non-discounted cash flow methods. Under that, we discuss only two techniques, which are the payback period as well as the accounting rate of return. In between, we discuss the areas of conflicts between decision of NPV as well as the internal rate of return. Not only that, before we close the class for the day, we also discussed how to identify relevant cash flow. Okay, we talked about relevant cash flow. So to in investment appraiser, then thereafter we are going to proceed. I will give you the format that you can use to calculate any of those techniques, be it net present value, internal rate of return, including adjusted present value, is the same format, especially when you have multiple variables. Whenever you have multiple variables, that is the format you are expected to use. Okay, then once we are done with that, then we are going to start illustrations. So today and the next class, we are going to be doing much of calculations. So I will share my screen with you. I need you to open to your material, and so that we will be on the same page. So let's talk about impact of inflation and taxation. Let me know if you can see my screen.
Can see your screen, sir.
All right, thank you. So we are not going to be discussing, we are not going to be giving the definition of inflation. It's something you're already familiar with, and something you can read on your material. But what is important is that, when you have a project, when a company wants to execute a project, it is important that to take into consideration all the variables that may impact the project under consideration. If there's going to be impact of inflation, you should consider it in your cash flow. Again, if the project generates profits, that profit needs to be taxed. Okay, the company is supposed to pay tax on the project. So, and how to incorporate the taxation as well as the inflation is what we want to discuss within the next minutes. Okay, so for the purpose of determining the financial viability of a project, there are two types of inflation. One is general inflation. The second one is specific inflation. So in most cases, on the day of your exam, all the variables that make up the project under consideration will be affected with different inflation. For example, the inflation rate for sales value may be different from the inflation rate for variable costs or inflation rate for working capital. When you have such a situation, it is called specific inflation. All right. But again, I don't want us to go into that to be discussing what is general inflation, what is specific inflation. The focus of today is to discuss the impact of inflation on cash flow. Okay. Generally, there are two types of, in relation to inflation, there are two types of cash flows. There is money cash flow, and there's also real cash flow. The money cash flow are cash flows that include the possible effect of inflation. I repeat, money cash flows are cash flows that include the possible effect of inflation. That is, they are inflated cash flow. What that means is that if you are given a money cash flow, it means that that cash flow has already been inflated. Therefore, there is no need for you to inflate it again. I repeat, if you have money cash flow, it means that the cash flow has already been inflated. There is no need to further inflate it. Now, if in a question you are given cash flow, an examiner did not mention whether it is real or whatever, it is assumed that that cash flow is a money cash flow, because in a question, all cash flow given are assumed to be money cash flow, except examiner says otherwise. Okay, so that is for money cash flow. What about real cash flow? It's just the opposite of money cash flow. Real cash flow are cash flow that does not include the possible effect of inflation. I take it again. Real cash flow are cash flow that does not include the possible effect of inflation. They are deflated cash flows. They are deflated cash flows. They are cash flow. Real cash flow are cash flows that are stated in today's prices, year one prices, first year prices, year zero prices, current value terms. I take it again. Real cash flows are cash flows that are stated in today's prices, year zero prices, first year prices, or current value terms. Okay? So if you are, for example, if in the question you are told that selling price in the first year equal is 1,500. Okay, examiner just told you in a scenario that selling price in the first year is 1,500 naira per unit. So because examiner has mentioned in the first year, it means that that 1,500 is real cash flow. Or possibly in the question you are told that variable cost in current value terms, 800 naira. I repeat, you are told in a question that variable cost in current value terms, 800 naira. Because examiner has mentioned current value terms, it means that that cash flow is real cash flow. And that is why I said that real cash flow are cash flow that are stated in today's prices, year zero prices, current value terms, year one prices. Okay, so once you see cash flow that are stated in those kind of way, then it means that they are real cash flow. So that is for cash flow. How do you then convert money cash flow to real cash flow, or real cash flow to money cash flow? Because on the day of your exam, if you are given inflation rates, it means that you must incorporate inflation into your cash flows. So how do you then convert real cash flow to money cash flow, or money cash flow to real cash flow? Let us discuss that. Now, when you want to convert money cash flow to real cash flow, ordinarily you are supposed to when you want to convert money cash flow to real cash flow, you are supposed to discount, okay? You are supposed to discount. Let me look for a space. Okay, let's use it. Now, this is what I'm saying. You want to convert money cash flow to real cash flow. It means that, as it is, it means that real cash flow will be the subject of the formula because you want to convert money cash flow to real cash flow. So as it is, I need to make the real cash flow the subject of the formula, which is what I want to calculate. I would then say real cash flow equal to money cash flow multiplied by 1 plus inflation rate raised to power, because I want to convert money cash flow to real cash flow. I'm supposed to discount. I would then say raised to power minus n. So when I do this, I'm simply discounting. Okay? When I do this, I'm simply discounting. However, that is number A. Number B, if in a question, and this is the one that is very common, in a question, you are given real cash flow and you're also given inflation rate. It means that you are supposed to calculate money cash flow. So to convert money cash flow to convert real cash flow to money cash flow, you are supposed to compound, meaning that you are supposed to increase your real cash flow to money cash flow equivalent. Therefore, I want to convert real cash flow to money cash flow. So as a result, money cash flow will be the subject of the formula. Therefore, I would then say real cash flow multiplied by 1 plus inflation rate raised to power n, because I want to inflate my real cash flow to money cash flow equivalent. So I'm supposed to compound. This is compounding. So when you convert real cash flow to money cash flow, you are compounding. When you convert money cash flow to real cash flow, you are discounting. So this is how to convert money cash flow to real cash flow or real cash flow to money cash flow. But the issue is that on the day of your exam, this formula, you are not going to need it for anything. It's just for explanation purpose, because it is implied by the time we begin calculation, we see what I'm talking about. You don't really need this formula for anything. Okay, so let's move on. Now, as you have cash flow, we also have discount factor. Let's talk about the effect of inflation on cost of capital. The effect of inflation on cost of capital. Similar to the cash flow, there are two cost of capital in relation to inflation. We have money cost of capital. We also have real cost of capital. The money cost of capital is the cost of capital that includes the possible effect of inflation. I repeat, the money cost of capital is the cost of capital that includes the possible effect of inflation. It is the cost of capital. It is also known as nominal discount rates. The money cost of capital is also known as nominal discount rate or nominal cost of capital or money rate of return. Okay. Except otherwise stated, the cost of capital given is assumed to be money cost of capital. If in the question examiner is silent as to the nature of the cost of capital, you are going to assume is the money cost of capital. Okay? Now, let's talk about real cost of capital. The real cost of capital is the one that does not include the possible effect of inflation. I repeat, The real cost of capital is the cost of capital that does not include the possible effect of inflation. It is the cost of capital that is stated in real terms. It is the cost of capital that is stated in real terms. All right. So how do you then determine money cost of capital or real cost of capital? For the purpose of inflation, in the calculation of discount rate or cost of capital, the Fisher effect formula, Professor Ivan Fisher effect formula is used to calculate money cost of capital, real cost of capital, or general inflation rates. Okay, let me use this place. Now, according to Professor Ivan Fisher, 1 plus money cost of capital is equal to 1 plus real rate of return, real cost of capital, multiplied by 1 plus inflation rate. So this is the formula given by Ivan Fisher. Okay, that's the formula given by Ivan Fisher. So it is this same formula you are going to use to calculate money cost of capital, real cost of capital, and then the general inflation rate. Because in a question, if you are not given money cost of capital, examiner can give to you real cost of capital and general inflation rate. So, and then the money cost of capital might not be given to you. So if that is the case, this is the formula you are going to use to calculate it. Again, if in a question you are given money cost of capital and general inflation rate, and then the real rate of return is not given to you, which you are expected to use, then it is the same formula you are going to use. It is also possible that you may want to calculate the general inflation rate. If not given to you, of course, the money cost of capital and the real cost of capital will be used to get the general inflation rate. So from this formula from Professor Ivan Fisher, how do you then calculate money cost of capital? That is, you want to make the M the subject of the formula. So from this first formula, to get the money cost of capital, I will say M equal to 1 plus R multiplied by 1 plus general inflation rate, or minus 1. So this is the formula you are supposed to use to get your money cost of capital. Again, if you are given money cost of capital and you want to calculate real cost of capital, that is, you want to make R the subject of the formula. Therefore, I would then say, from this first formula, you will see that 1 plus R is multiplied by 1 plus I. What that means is that I cannot leave any of those two. Therefore, for me to get R, I need to divide both sides by 1 plus I. Therefore, I would then say R equal to the one on the left, which is 1 plus M, divided by, I'm dividing both sides with 1 plus I. 1 plus I would then say 1 plus general inflation rate, or minus 1. The one that is standing, is 1 plus R. So I would then say minus 1. Let me write this one. Okay. So this is the formula for calculating real cost of capital. So if in the question I want to determine general inflation rate and I'm not given, I can then say the same way you calculated your real cost of capital, I will say general inflation rate equal to 1 plus M divided by, because the 1 plus R is also disturbing 1 plus I. So therefore, I have to divide both sides by 1 plus R. I would then say 1 plus R. All of this minus 1. So these are the relevant formulas you can use to calculate your cost of capital under inflation. Now, there's one more important thing we need to discuss before we end inflation, impact of inflation. Now, There are general rules that you must apply whenever you want to incorporate inflation into your cash flows. The first rule states that money cash flow for money cost of capital. I repeat, the first rule stated that money cash flow for money cost of capital. Rule number 2, real cash flow for real cost of capital. Rule number 2, real cash flow for real cost of capital. Rule number 3 states that money cash flow should not be used for money cost of capital. Sorry, real cost of capital. I repeat, rule number 3 states that money cash flow should not be used for real cost of capital. Rule number 4 states that real cash flow should not be used for money cost of capital. Rule number 4 states that real cash flow should not be used for money cost of capital. Those are the 4 common rules. But more importantly, and you have to pay attention to what I'm about to say, because on the day of your exam, what you are going to need whenever you want to inflate are based on this information that I want to shoot out to you. More importantly, number 1, when cash flows are stated in first year prices or year 1 prices, inflation should start from year 2. I repeat, when cash flows are stated in first year prices or year 1 prices, inflation should start from year 2. What that means is that once you are given a first year price, that first year price is the base year price. So you don't inflate base year price. So you have to move to the following year. So once you are given first year price or year 1 prices, you should start inflating from year 2. You don't inflate the year 1 cash flow. Please note that. The second part is that when cash flow are stated in today's prices, year 0 prices, current value terms, then inflation should start from year 1. I repeat, when cash flows are stated in today's prices, year 0 prices, or current value terms, inflation should start from year 1. I hope that is very clear. Because on the day of your exam, in fact, the current value terms is very common. Current value terms and the first year prices are very common. So if you are told in the question that selling price in the first year or in first year prices equal to 2,000, it means that that is a real cash flow. So I will not inflate the year 1 price because I've been given the first year prices. Again, if you are told in the question that working capital in current value terms is 5,000, because examiner has mentioned current value terms, it means that that is a real cash flow. Therefore, I have to start inflating from year 1. If examiner does not tell you in current value terms, examiner can say variable cost currently is 2,000 naira. Because examiner has mentioned currently, it means that that 2,000 naira is in current value terms, which is real cash flow. So all these basic things, you need to understand them. And once you do, you have no, you are going to get to the right answer. Because once the foundation is wrong, whatever you do thereafter will also be wrong. And that's why you need to understand the impact of inflation and taxation when you have them on the day of your exam, particularly at this professional level. There's hardly a question you are going to have on that day that involves capital budgeting that you are not going to have inflation or taxation. Therefore, you must know how to treat them. All right. So let's talk about impact of taxation and in investment appraisal. So you can go back to your material, read everything you have there in your under the inflation. What is inflation? Examiner cannot be asking you on the day of your exam, what is inflation? What is, no, it doesn't happen that way. All right. At this level, no, that cannot happen. But again, it's good for you to know. Please go through there. Make sure you read the material A to Z. I just gave you now what you need to know for the purpose of your exam. All right. So you can add more through your personal research. Okay. Now let's talk about impact of taxation. Now, basically, there are three purposes in which a business should consider the impact of taxation in investment appraisal. One is the determination of tax liability. Okay, one is the determination of tax liability. Then two is to determine tax saved on capital allowance. Two is to determine tax saved on capital allowance. And three is the timing of the cash flow. You want to know when and how should the company pay tax or claim capital allowance. You want to know when to pay tax or to claim capital allowance on the qualifying capital expenditure. So those are the three purposes of incorporating tax in capital investments. Now, the first one, which is to determine tax liability, that's very straightforward. But one thing you need to understand is that tax is paid when a company makes profits. What that means is that once a company makes loss, you don't pay tax. You have to carry your loss forward until you're able to recover it, then you begin to pay. You only pay tax when you have profit. So in a year where a company makes loss, you don't pay tax. You have to ignore. You leave that side, move to the next one. Okay? Now, that one is very straightforward. To get your tax liability, you just multiply the company tax rates on the taxable profit. That's all. That's very straightforward. No issue. So let's go to the second one, which is the determination of capital allowance. So for the purpose of capital investments, capital allowance is granted in lieu of depreciation. I repeat, for the purpose of capital investments, capital allowance is granted in lieu of depreciation. And then when you talk about capital allowance, it's just an allowance claimable by a business for incurring qualifying capital expenditure. Meaning that when a company incur qualifying capital expenditure on non-current assets, like building, motor vehicle, furniture, anything that is capital in nature, all right? And once the asset is acquired, the company is entitled to claim capital allowance on those assets. So how do you then determine your capital allowance? Before we talk about how to calculate capital allowance, you must understand the types of capital allowance. There are basically 4 types of capital allowance in relation to finance. I take it again. In relation to finance, there are 4 types of capital allowance, and any of these 4 may come out on the day of your exam under capital allowance. The first type of capital allowance is initial allowance. The initial allowance is an allowance claimable once in the lifetime of the assets. I repeat, initial allowance is the allowance claimable once in the lifetime of the assets. So once you claim for the first year, it's not going to be repeatable again because it's not repeatable. It's for life. Once you claim it, that's it. You can't claim it again. So that is initial allowance. In most cases, initial allowance will not be there in your question. So it's not common. It's not common. So that's for that. The second type of capital allowance is annual allowance. The annual allowance is an allowance claimable every year until the final disposal of the assets. I check it again. The annual allowance is the allowance claimable every year until the final disposal of an asset. So year one, let's say for example, the useful life of an asset is 5 years. So in year one, you are going to claim capital allowance, annual allowance. In year two, you claim annual allowance. Year three, year four, you also claim annual allowance. The final year, which is year five, when you dispose the assets, then of course, in that year, you are not going to have annual allowance. You can either have balancing allowance or balancing charge. So which will take us to the third type of capital allowance, which is balancing allowance. The balancing allowance represents the difference between tax written down value from the preceding year and the sales proceed at disposal. I repeat, the balancing allowance represents the difference between the tax written down value from the preceding year and the sales proceed at disposal. The balancing allowance arises when the tax written down value from the preceding year is greater than the sales proceed. I repeat, the balancing allowance will arise when the tax written down value from the preceding year is greater than the sales proceed. Now, this is what I'm trying to say. Say, for example, you have an asset that has a tax written down value of 200 million naira. Then this asset is disposed, scrap value. This asset is disposed at 150 million. Okay? The asset that worth 200 million naira is being disposed at 150 million. Therefore, the difference of 50 million, which is 200 million minus 150 million, represents the balancing allowance. The difference between the tax written down value from the preceding year and the sales proceed represent the balancing allowance. So that is that. So let's talk about balancing charge. The fourth type of capital allowance is balancing charge. Balancing charge represents the difference between tax written down value and then the sales proceed at disposal. The balancing charge will arise or will occur when the tax written down value from the preceding year is lower than the sales proceed. I repeat, the balancing charge will occur when the tax written down value from the preceding year is lower than the sales proceed. So, for the purpose of demonstration, let's say you have a tax written down value of 500 million naira, and this asset is being disposed. The asset is being disposed at 600 million. This means that the company has gained at disposal. The company has gained 100 million naira at disposal. That 100 million naira extra that the company has gained will be taxed in the hand of the company. Therefore, that is balancing charge. Balancing charge is just a form of a tax liability. So it's a tax liability. So as a result, I would then say balancing charge, the difference is what I'm going to account for. The difference between 500 and 600 million represents 100. So this 100 million is called balancing charge. Okay, this is balancing charge. That is 500 million minus 600 million. So the balance of 100 represents a balancing charge. All right. So these are the types of capital allowance you must get familiar with. Like I told you earlier on, the initial allowance is not common. It's not common in capital budgeting. However, annual allowance is mostly what you are going to need from the beginning of the project when you want to determine your capital allowance, from the beginning until the final disposal of the assets, when you are going to consider balancing allowance or balancing charge. Okay, so these are the things you need to know as per the types of capital allowance. Now, what are the methods of determining capital allowance? There are two methods of calculating capital allowance. One is straight line depreciation method. The other one is reducing balance basis. Okay, one is straight line depreciation method or reducing balance basis. Now, when it comes to straight line depreciation basis, your capital allowance for all the relevant year will be the same until the final disposal of the assets when you are going to consider the difference between the tax written down value and the sales proceed. I repeat, if you are using straight line depreciation method to determine your capital allowance, it is the same amount you are going to have from the first year up until the final disposal of the assets when you are going to consider the difference between the tax written down value and the sales proceeds of the assets, whether you are going to have balancing charge or balancing allowance. But when it has to do with reducing balance basis, if you are using reducing balance basis, of course, you are going to be multiplying the capital allowance rates on the tax written down value. Okay, using reducing balance basis, we are going to multiply the capital allowance rates on the tax written down value. Again, until the final year, when you are going to consider the difference between the tax written down value and the sales proceed, whether it will result in balancing allowance or balancing charge. So these are the things you need to know under methods of calculating capital allowance. Now, how do you then calculate? How do you calculate your capital allowance before we talk about tax saved, timing of cash flow rather? How do you calculate your capital allowance? Now, when you want to calculate your capital allowance, this is the format you are expected to use to get your capital allowance. In year 0, you are going to have the cost of the assets. At times, you have to watch out. Examiner might give to you a second-hand asset. When you are given a second-hand asset, you can't claim capital allowance on a second-hand asset because the original owner must have been claiming the capital allowance. And that's why we said that capital allowance is claimed on a qualifying capital expenditure. So if you are given, I'm now saying that if you are given a second-hand asset, you don't calculate capital allowance on that. You have to ignore. However, so we're assuming on this format, we're assuming it is a qualifying capital expenditure. Say, for example, equipment. Therefore, I would then say, I'll pick the cost of the assets. I will post. I will then go to the question. Am I given initial allowance rates? If I'm given initial allowance rates, and I'm also given annual allowance rates, therefore, that means in year 1, I'm going to have 2 capital allowance. So I will multiply the initial allowance rates on the cost of the assets. initial allowance rate multiplied by the cost of the assets. Whatever it is, I'll post it. Again, in that year one, I will go and do my working. My annual allowance rates multiplied by the cost of the assets. Whatever it is, I will post. I will add the two of them together. I will then go to year one. I will go and post it in this place. That will be my year one capital allowance. Okay? So I will less from the cost of the asset to have my tax written down value. But like I said, in most cases, you are not going to have the initial allowance. Okay? So in this format, we're assuming that tax will be paid, capital allowance will be claimed using depreciation method. Therefore, in year two, or using reducing balancing basis. So in year two, when I want to calculate my capital allowance, when I say capital allowance, I mean annual allowance. So I'm going to multiply the company, the capital allowance rates. I will multiply the capital allowance rates on the tax written down value. Whatever it is, I will come and post. Then we're assuming in this format that the useful life of this asset is 3 years. Therefore, in the final year, which is year 3 now, I will need to the first thing I will do is that I will pick my tax written down value from the preceding year. I will now compare with the scrap value or sales proceeds. So the difference will give me either balancing allowance or balancing charge. If the tax written down value from the preceding year is higher than the sales proceeds, that will give me the balancing allowance. But if the tax written down value from the preceding year is lower than the sales proceed, it will give me balancing charge. Therefore, of course, something is missing here that's supposed to be a negative X, which is for balancing charge. So, all these items that I label, let me write it so that it will be clearer. All these items, this, and this represent capital allowance. Therefore, when I now want to calculate my tax saved on capital allowance, because the essence of capital allowance is to reduce tax liability. I repeat, the essence of capital allowance is to reduce tax liability. So I can use capital allowance that I've computed, this, to reduce my tax liability. I can either use my capital allowance or I use tax saved on capital allowance to reduce my tax liability. Whichever one I use, I'm going to arrive at the same answer at the end of the day. All right. So in most cases, I will advise you to use tax saved on capital allowance because the format I'm going to give to you, what you have there is the tax saved on capital allowance. Therefore, if I want to use tax saved on capital allowance to reduce my tax liability, I need to multiply the company tax rates on the capital allowance I've computed for each year. Therefore, let's say, for example, the tax rate is 30%. I would then say 30% of the capital allowance I have in year one, I will come and post. 30% of capital allowance I have in year two, I will post. 30% of capital allowance in year three, I will post. Either positive or negative, whatever it is, I will post it there. So that means I've calculated my tax saved on capital allowance. After this, immediately I finish calculating my tax saved on capital allowance, I need to add everything together. This will give me the total tax saved. Total tax saved, TTS. Now, it is important for you to ensure that you don't claim beyond the capital allowance a company is entitled to. For this purpose, it is important for you to confirm the capital allowance that you're about to claim so that you don't exceed the total capital allowance claimable. How do you confirm that you have exact capital allowance claimable in this place. So to confirm that, then you are going to use a formula. Total tax saved claimable is calculated as the cost of the assets minus the scrap value multiplied by company tax rates. When you do this, whatever you have will be the same thing as what you have here. The two of them must equal. Your total capital allowance, your total tax saved on capital allowance must be equal to the total tax saved that you have using this formula. In a situation whereby your capital allowance, your total tax saved is higher than when you use this formula, maybe by 1, all you need to do is to come back to the capital allowance that you have computed and adjust it by 1 so that it will be equal to what you are supposed to claim. So this is what you need to know in the calculation of capital allowance. So on the final note, under taxation, let's talk about timing of cash flow. You want to know when are you supposed to pay your tax or when are you supposed to claim your capital allowance. So tax can be claimed, tax can be paid in the current year or in arrears. When the profits is subjected to tax in the same year the profit is earned, it means that you are using current year method. But if tax are paid in arrears, it means that the profits of the last 12 months will be subjected to tax in the current year, or the profit of last year will be subjected to tax in the current year. Okay, that is under arrears. But there is one more important thing you need to understand here, that your tax saved on capital allowance must follow the patterns of your tax liability. I repeat, the tax saved on capital allowance must follow the pattern of tax liability, which means that if your tax liability is in the current year, your tax saved on capital allowance must also be in the current year. If your tax liability is paid in arrears, your tax saved on capital allowance must be claimed in arrears as well. Okay, so you need to watch out for that as well. I think that is all you need to know in relation to taxation. All right, this is all you need to know. Please go back to your material and read them through so that you have deep understanding of the impact of taxation. So finally, you need to have a format for calculating, let me see if I can get a bigger space. Format for calculating NPV, NPV, internal rate of return, or payback period, or adjusted present value. Now, in a question, when you have multiple variables, if in a question you have sales value, variable cost, specific fixed cost, other relevant costs, in that same question, you have taxation, you have inflation, you have working capital, you have other variables. In that case, you cannot use the small table for calculating NPV. Rather, you are supposed to use a columnar format to present your work. Therefore, without wasting more time, in the determination of financial viability of a project, the following format that I want to give to you should be used when you have multiple variables. Say, for example, I want to calculate net present value. I will then say, calculating net present value. Let's assume that our figures are in million, and this project has 3 years life. Our figures are in million, and the project has 3 years life. Therefore, I will create a column for year 0, year 1. Let me adjust a little bit. Year 0, year 1, year 2, year 3. Then I will have workings. I'll create a column for workings. I don't know the extent of my table on the day of the exam. So this is how you are going to do it. You may likely have, you are going to have sales value, you have variable costs, okay? You can have direct, incremental, specific or attributable fixed cost. Okay? Fixed cost. You can also have, okay, let's limit it to this. So, of course, in year 0, you don't usually have this, and you have this, you have this, you have this. Okay. So I have to total this. Coming back to this, let me finish this side. So I will then have the profits. After profits, we are going to pay tax. Tax at company tax rates. Then you are going to have tax saved on capital allowance. Then you can have scrap value. You're also going to have initial outlay. Let me write that. Then you are going to have working capital. After that, you have your net cash flow. After the net cash flow, you have your discount factor. At whatever percentage. Then you are going to have present value. Then finally, you have your net present value. Okay, so I can then draw my table. Draw my table. My NPV is my targets. Don't mind my hand. It's not straight, but manage it. I'm not using a ruler. Okay then. So at this point, oh, sorry. Shouldn't have drawn this one down. This one's supposed to stop here. This one will stop here. Okay. All right then. So this is what you are going to do. When you want to calculate your sales value, you go to the question, do you have selling price? If you have selling price, ordinarily you are supposed to multiply your selling price with the number of units sold. However, before you multiply your selling price with the number of units sold, you need to go into the question if you have inflation rates. So if there's inflation, excuse me, if there's inflation rate on selling price, you need to first of all inflate. Once you inflate your selling price, you multiply with number of units, then you come and post. Then you have your working number one. You go back to the question. Do you have variable cost? If yes, is there any inflation on variable cost? If yes, then you inflate the variable cost per unit. Multiply with number of units produced. Then you come and post. That's your working number two. Again, in the question, you need to ask yourself, are you given fixed cost? What kind of fixed cost? Is it direct fixed cost? Is it specific fixed cost? Is it attributable fixed cost? Or is it incremental fixed cost? Provided the fixed cost is relevant, you need to come and post. Again, before you post your fixed cost. So generally, you are not supposed to do working for direct fixed cost. So just multiply the inflation rate with the fixed cost given to you, and you get your answer. But again, if you want to do working for that, that's no problem. So at this point, I need to find my taxable profits. I will then multiply the company tax rates on the taxable profit to have my tax liability. For the purpose of this demonstration, our assumption is that tax will be paid in the current year in which the profit is earned. Then I will go ahead and determine my tax saving on capital allowance. Whatever I've calculated, I will come and post to reduce my tax liability. That will take me to working number 4. Then my extra value will also be given to me at the final year of the assets. My initial outlay will occur in year 0, the cash outflow. Again, I'll go into the question, am I given working capital? Remember, there are two types of working capital. You can have incremental working capital or one-off working capital. Whatever the nature of the working capital, you understand how to treat it. So for the purpose of these templates, our assumption is that the working capital will be incurred in the first year, meaning that we're supposed to treat it as cash outflow in year 0. Then at the end of the useful life, we'll recover the working capital. Okay? Then at this point, we need to determine the net cash flow. I will then add up everything. I will have this cash outflow, cash inflow, cash inflow, cash inflow. So at this point, I will go back to the question, am I given cost of capital to use? At times, examiner may not give you cost of capital. It may well be that you are the one that will compute the cost of capital. Whatever the case may be, I will pick my cost of capital. I need to find the discount factor. Okay, I need to find the discount factor. Whatever the discount factor is, so I'll put it there. Then I will then multiply. I will get the present value of cash inflow. Then I will get present value of cash outflow. Therefore, my NPV, which represents the difference between present value of cash inflow and present value of cash outflow. So this is how I'm going to calculate my net present value. However, for other techniques like payback period, modified internal rate of return, discounted payback period, adjusted present value, okay? In fact, including project duration. Whatever you have here at this net cash flow, you can use it to calculate anything. This net cash flow can be used to calculate anything, all right? So watch out for that. This format is only suitable when you have multiple variables. The format is suitable when you have multiple variables, all right? So that's that. So these are the explanations that you need to get familiar with under capital budgeting. So at this point, we have spent about 1 hour. So let's go into calculations. So before that, please let me know if you have any question for me so far. Let me know if you have any question for me so far. So in the absence of no question, let's continue to have, let's have illustration. Let's have illustration. Okay. Let me see. Okay. Zainab has joined. Abdullah has also joined. Wilson joined late. Okay then. Who is user? Please remind me of your name, user. User. Who is user? User. Okay. No worries. Move on. So I need somebody to read for me. Illustration number 2. Let's attempt illustration number 2. Who is helping us to read? I've been doing the talking since. So I asked you to ask me question. No, none of you ask any question. So I want you to participate. So I need somebody to read for me. Who is reading the question on Washington PLC?
Okay, let me read, sir.
Who is that person?
Abu
Who?
Fidelis.
Oh, okay. Oh, you are the user.
Yes, sir.
It's okay. All right then. Go ahead. Thank you.
Okay, the question goes to illustration number 2. Washington PLC is considering a project whether or not to commercialize an initiative muzzle touring device, MTD, that will be used in the treatment of sporting injuries. It is expected that the commercialized life of the MTD will be 4 years, after which technological advances will bring more sophisticated devices into the market, and the sales of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over past year. Initial market research has been conducted as a cost of 2.5 million and is due to be paid shortly. Information on future returns from the investment has been forecasted to be as follows. All figures assumed to be corrected. Selling price inflation rates and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device will cost 120 million, and additional initial investment of 20 million will be needed for the working capital. The equipment is expected to be sold at the end of 4 years for about 10 million when the production and sales cease. The average general level of inflation is expected to be 3% per year, and working capital could experience inflation of this level. Capital allowances, tax allowable depreciation of 25% on a reducing balancing basis will be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. The balancing allowance will be claimed in the 4th year of operation. Washington, D.C. has a real cost of capital of 7.8%. You are required to A, calculate NPV, IRR, and discounted payback period, 22 marks. B, on the basis of NPV, advise if the project could be considered, 3 marks. What are the 4 assumptions on the calculation above? 5 marks, total of 18 marks, 30 marks rather.
Thank you very much, Fidelis. That is the question. Now, whenever you are given a question, before you start reading the body, you have to start from the requirements, because that will help you to understand the expectation of the examiner. In this question, you are required to calculate NPV, IRR, and discounted payback period. So now that you know what you want to calculate, so you can then proceed to reading A to Z of the question. But one thing is certain is that in this question, we want to calculate NPV. See, on the day of your exam, there's no need for you to be wasting time, okay? You know that you want to calculate NPV. I explained to you previously that when you want to calculate NPV, there are basically 3 variables that must be present. There are 3 criteria you must look out for in the question whenever you want to calculate NPV. One is relevant cash flow, which is what we discussed last time, okay? 2 is appropriate cost of capital. It is also possible in the question that examiner may not give to you the discount rates that you are going to use. It may well be that you are the one that will calculate the cost of capital. Then number 3, to calculate your NPV, you need useful life of the project. So those 3 elements must be present whenever you want to calculate NPV. I repeat, to calculate NPV, you need relevant cash flow. 2, you need appropriate cost of capital. Then 3, the useful life of the project must be given. However, in most cases, examiner will provide for you the useful life of the project. Examiner will also provide the appropriate cost of capital to be used for the evaluation. But in all of this situation, relevant cash flow will never be given to you. It is your responsibility to be able to go into the question and identify which of the cash flows are relevant, which one are not relevant. So what that means is that where you have major work is your ability to identify relevant cash flow. And that was why I took my time to explain to you what relevant cash flows are all about. All right. So to solve this question, I will switch to the working note so that I'll pick it from there one after the other. Let me share my working note with you. Let me know if you can see it. Can you see my working notes?
Yes, yes, sir.
All right, thank you. So if that is the case, so let's solve now. Let me increase the consider to be bolder. Now, the name of this company is Washington PLC. I would then say Washington okay. Examiner asks us to calculate NPV, IRR, and then discounted payback period. I would then say, of course, this is, let's do it properly, solution to illustration number 2, okay? The name of the company is Washington PLC. So there are 3 requirements in number A. So I would then say A1. Requirement A1, calculating net present value. net present value. Please, on the day of your exam, don't go and be writing NPV. You have to write it out in full. Net present value, at least for the first instance, you write it out in full. Then you now put in brackets NPV, so that going forward, you only be referencing NPV. So let's go back to the question and check. Are we given our figures in thousands or in million? We are given fixed costs in current value terms in million. So that means let's restrict our numbers to million. Okay, let's restrict our number to million. So I will then go back to the question. I'm teaching you the exam technique. I will go back to the question, what's the useful life of this project? Because that will help me to design my table properly. The useful life of the project is 4 years. Okay, in the table, you are given 4 years. That's not sufficient for me. I will go back to the question again and go and look for the portion in the question where I have tax liability. Examiner told us that profit tax of 30% per year will be payable 1 year in arrears. So tax is payable 1 year in arrears. It means that the life of this project will be extended beyond year 4. So I have additional 1 year. Therefore, I have year 0, year 1, year 2. Let me reduce the size. Year 0, 1, 2, 3, 4, then year 5. After that, I will create a column for workings. So I will not rule my table first. The first thing I will do is to go and calculate. I will go to the question. Am I given selling price? Yes, that's a selling price. Therefore, I will need sales. I will go back to the question again. Am I given variable cost? Yes, there's a variable cost. So I will come and post. I'll write it down first before I go and do my workings. Then I will go back to the question. Am I given relevant fixed cost? Yes, there is a relevant fixed cost, but that notwithstanding, well, for now, let us just go ahead with our calculation. So I want to calculate sales value. I need sales value. I will then go to the question, where can I get sales value? So there's no need for you to be reading the question A to Z. After you have written the question once, no need to be reading it all over again. The only thing you are going to be doing is to be picking relevant cash, anyone that you know that is not relevant, then you just be underlining it so that you don't need to come back to, you don't need to do anything on those ones. Now, I will then go straight to where I have information on my selling price. I want to calculate sales. I need sales, I need selling price. When you look at the question in the table given to you, you are given selling price in current value, in current price terms, 2,000 naira, 2,200 naira, 1,600 naira, and 1,500. Because examiner has mentioned selling price in current price terms, it means that my selling price is real cash flow. I repeat, because I'm given selling price in current price terms, it means that my selling price is real cash flow. What that means is that I need to convert it to money cash flow. So to convert it to money cash flow, I will then go and do my working. Before I do my working, I need to go and, of course, this first page, this page will be for the NPV that we are calculating. The second page will be for internal rate of return, as well as a discounted payback period. Then the fourth page will then be for my working. Let me start working from here in case anything slipped to the fourth page. So I will then say workings. Okay. Working number 1. Before that, I will need to create space for year. I have year 1, year 2, year 3, then year 4, because the useful life of this project is 4 years. I will go back to the question. Am I given units? Please, I need you to participate. When I'm asking for figures, you have to provide for me as quickly as possible. So the demand in unit is 20,000 naira for the first year. So I need somebody to give me for the second year. We are going to sleep here together today, or if you don't give me numbers. I need you all to participate. Give me numbers.
Me, I don't have this material, but I'm giving you the number.
20,200. I can share the material so we can be giving you numbers.
Year three is what?
The material is just.
You don't have it. We have shared it now. We shared it. Is in your, what do you mean you don't have the material? We have shared the material with you. Or you didn't notice it in your email?
Yes, I
Huh?
didn't notice it. Yes, I didn't notice it.
Okay. Sorry about that. Okay, let me quickly share on your WhatsApp. Just give me 3 minutes. You guys should have talked now, right? You don't have it and you kept quiet. Are you aware that your ICANN has posted the exam date today? It has been published today. So your exam is in May 14 through 16. So what that means is that now the journey for you to become a chartered accountant starts today. You have to start reading now aggressively. You have to start reading aggressively because time and child wait for nobody. Before you know it, May 14, here I come. So please, you need to build your confidence. You need to start building your confidence. So it's important. And the earlier, the better for you. If you are keeping your studying to the final day, you are not helping yourself. You are going to struggle by that time. By end of March, you would have covered substantially the scope of the syllabus, so that in April, all you'll be doing is just an addition. Therefore, I encourage you all to please go ahead and conquer ICANN. You can only defeat ICANN if you take your exam very seriously. You have to read as if your everything depends on this exam that you want to write, because at this final stage, you don't give any chance for liberty. Okay, you don't give liberty for license. You have to take everything seriously. I mean, with all seriousness. I pray that God Almighty will make it easy for you. So now that you have the material, how much is year three? What is year three unit? Unit for year three?
1 to 5,000.
125. Year four?
20,000.
Okay. So these are the number of
No,
units.
20.
20,000. Okay. So these are the number of units to be produced and sold. All right. I would then say working number one, sales. So I want to calculate my sales. To get my sales, I'm going to start from the selling price. Okay. Because I would have teach you the right way to do this, to do your inflation, but because we are given different selling price, so that will not afford us. But the most important thing you are going to do is to pick up all the selling price for the respective years. So what about the year two? Debbie, give me the number. Year two selling price.
2,200.
2,200. Year three?
1,600.
1,600. Year four?
15.
15. Thank you. So at this point, I need to inflate my selling price. I will then go to the question, what's the inflation rate for selling price? If you go to the paragraph after the table, you are told that selling price inflation rates and fixed cost inflation are expected to be 5% per year. So my inflation rate is 5%. So I will say at 5%. Let me write that, make it bolder. Okay, so this is A. Now, I would then say 1.05. Before I start inflating, I need to go back to the question and check what is the nature of my selling price. Examiner told you that selling price in current price terms, it means that I should start inflating from year one because my selling price is given to me in current value terms. So I should start inflating from year one. I would then say raised to power 1, 1.05 raised to power year 2, 1.05 raised to power year 3, 1.05 raised to power year 4. So at this point, I need to determine my inflated selling price. Okay, which will be B. This is inflated selling price. So 1.05 raised to power 1 multiplied by 2,000. What do you get?
2,100.
2,100. Thank you. I will say 2,100. 1.05 raised to power 2 equal, multiplied by 2 equal. What do you get?
2,425.
26.
2426 approximately. Then 1.05 raised to power 3 multiplied by 16.
1,852.
1852. The last one.
1,823.
1,822.
822.
Like this?
23.
23. Okay. Now, I've calculated my inflated selling price. At this point, I need to get my sales. I would then say sales. My figures are in million. This is A multiplied by B. So what do you get? A multiplied by B. That is the number of units sold multiplied by inflated selling price. What do you get?
42 million. 42 million.
42. Yes.
169,820,000.
169.
820,000.
That's 170 rounding.
Okay.
That's 170. Next.
Two, 23 million 150.
2, 3, 1. 23,150,000.
Yes, sir.
And our figures are in millions. So are you saying it's 23?
No, 231 million 500.
Okay, that's 234. 231, that's 232. Is it 232? Rounding?
Yes, sir.
All right then. Year 4.
36,460,000.
Take it again.
36,460,000.
36 million. Remember, we are using thousands, I mean millions. So are you saying it's 36?
37, approximately.
37.
37.
Approximately. Yes.
These numbers are not right too, because year 1 is 42. Year 2 is, oh, okay. Yeah. Number of units is those ones are 70, then 130. It's correct. All right then. So now that I have my sales value, I need to go and post. So the first year is 42, 170 for year 2. 42, 170. So here is 42, 170, 230, whatever. I think 232. Let me confirm.
32.
232, then 37. Thank you. 232, 37 dash. This is working about 1. So I would then go to the question. I would then confirm if I have variable cost. Again, from the table, you are told that variable cost in current price terms 900, 1,000, 1,020, 1,020. So let's go and do our working for variable cost. Working number 2, variable cost. Variable cost per unit 900.
1,000. 1,000.
1,000, 1,020, 1,020. Okay, so I have inflation. What's the inflation rate for variable cost?
4%.
That is 4%.
Okay, inflation at 4%. I would then say 1.04 raised to power year 1, 1.04 raised to power year 2, 1.04 year 3, 1.04 year 4. Remember, our variable cost is in current price in the current price terms. Okay. So give it to me. What's the inflated variable cost? $1.04 raised to power 1 equal multiplied by 900. Yes.
$936.
936. Somebody should do year 4. Yeah. Another person should do year 3, then year 2, so that we can move faster.
1,082.
1,082.
Year
Yes.
3, 1,147.
1,000. Did you say 1?
137.
Okay, 1,137. 137. Like this?
Yes, sir.
Year 4.
1,193.
193. So at this point, we need to get the total variable cost. Total variable cost in million, which is A multiplied by C. Number of units multiplied by inflated variable cost. 20,000 multiplied by 936. What do you get?
18.
80,727.
18 million.
720.
That's 19 million. Rounding. Next. 70 multiplied by 1082.
78 million.
Okay.
Or 76 million. Sorry.
76. Abu, are you still there?
Yeah, I'm here, sir.
Wilson,
next
you
one.
are. Yeah, the next.
142,125,000.
Pardon?
142.
142 million.
142 million.
Yes.
Year 4. Wilson, you are not participating. I've not heard your voice.
24.
24 million.
Yes, sir. I don't want to disturb the class because the point is that I've not been added to that group, so I don't still have the material. I don't want to more like disturb the class again. That I don't have the material. That is the thing.
All right. Move on. Now that I have my variable cost calculated, I need to go and post 1976. 1976 variable cost dash 1976 142. Am I correct?
Yes, sir.
What about year 4? Year 4 we had 37. No, 24.
Sorry, sir. Do we have the
24.
solution in the material you shared? Hello, sir.
What did you say?
Do we have the solution in the material you shared?
It's not there. That's why you have to pay attention.
I have to share
Because
later.
that's why I don't like giving, because once you are giving solution, most of you will not join again. Instead of you think you know it all, until when you now face the live question, then you realize that no, I've made a mistake. I would have paid more attention. So that will never be your portion. So let's move on from there. Now, we have inflated sales and also variable costs. Let's go back to the question and identify other relevant cash flows. In this question, you're also given fixed cost in current price terms, 10 million naira each for each year. If there is no further information on the fixed cost, the fact that examiner has told you your fixed cost is a current price term does not mean that it is a relevant fixed cost. All right. Remember, I told you there are 3 ways examiner can test fixed cost in a question. If you are given fixed cost, no further information, it means that that fixed cost is irrelevant. We ignore, because fixed costs are costs that has no sympathy for activity level. Irrespective of whatever the level of unit produced, your fixed cost will never change. However, the second area where fixed cost can be given in a question is that examiner can tell you that fixed cost, including depreciation. When you are given fixed cost that included depreciation, it means examiner wants you to do something. Therefore, you need to go ahead and calculate annual depreciation, not less that annual depreciation from the fixed cost. Whatever you have thereafter represents your relevant fixed cost, which you are going to account for. The third way in which examiner can test fixed cost in a question is that examiner can tell you that fixed cost, excluding depreciation. When you are given a fixed cost that excludes depreciation, that fixed cost is relevant. We have to account for it. But in this question, examiner told us that fixed cost in current price terms. So we don't know whether it is relevant or not. Let's go for additional information. If you have other information that relate to fixed cost, then we can account for that. When you look at the second paragraph, the paragraph that follows the table, you will see there's a statement there that says that, where is that? I'll talk about
Fixed cost represents incremental fixed cost.
Aha. I'm even trying to, yes. You are told that fixed costs represent incremental fixed production overhead, which are wholly attributable to the project. Examiner has told you that that fixed cost is incremental in nature. That means it is a relevant fixed cost. You have to account for it. Not only that, examiner says it is wholly attributable to the project. Therefore, it is relevant. So in this case, I don't need to do working for my fixed cost. I will just say incremental fixed cost. Incremental fixed cost at 10%. What's the inflation rate of fixed cost?
5%.
At 5%. Thank you. Okay, so I'm trying to avoid the situation whereby, because I've not ruled my table, so I want to be sure. Okay, so our inflation rate on fixed cost is 5%. And remember, your fixed cost is in current value terms. Okay, so if that is the case, and our fixed cost is constant at 10 million naira, therefore I would then say 1.05 multiplied by 10. That should give me 10.5, isn't it?
Yes, sir.
So 10.5, that's rounding, that's 11. So 10.5 multiplied by 1.05, what do you get? $10.5 multiplied by 1.05 equal
11.
11.025. So rounding is 11. The answer you have in your calculator multiplied by 1.05 equal, that's 11.576. So 576, so that's 12. The answer you have in your calculator multiplied by 1.05,
12.11.
that's 12. So I'm done with my working on fixed cost. Okay, these are cash outflow. Now, I would need to go back to the question. Is there any other relevant cash flow? Is there any other relevant cash flow? In the first paragraph, that we have some cash flows there. In the first paragraph, we are told that 8 million naira has been spent in developing and testing the device over the past year. Development cost of 8 million naira. Is it relevant or irrelevant?
Irrelevant.
Why is it not relevant?
It's not relevant.
Why is it not relevant? Why? Yes. The 8 million naira is not relevant. True, but why?
It has been spent before the project.
Because it has been spent. It's a sunk cost. That's what the examiner wants you to say. It's a sunk cost. All right? It's a past cost. Then we're also given initial market research. We are told that initial market research has been conducted at a cost of 2.5 million naira and is due to be paid shortly. The 2.5 million naira has not been spent. So relevant or irrelevant?
It's still not relevant.
Why is it not relevant?
It's also a stock
Pardon?
because
Why?
it's a stock cost too.
You
It's
know,
stock cost.
yeah, examiner told you that the initial market research has been conducted at a cost of, irrespective of when the payment will be made, it's a past cost. All right. It's that activity has been completed. So it's a past activity. Therefore, it does not have any influence on the future decision that is to be taken. Remember, when I was explaining historical costs, I gave you the example of historical costs as market survey, feasibility study fee or
Research.
cost. That also talk about market research cost or development cost. These are examples of some costs. When you see them in a question, you have to ignore it. Okay? So let's read through again the question. Any other cash flow that we are given that we have not considered? So far, no other cash flow again, except that the initial outlay of 120 million naira, as well as working capital, which we are going to treat later on. So if that is the case, let us determine our taxable profits. All right, so somebody should give me year 1, year 2, year 3, year 4, and they give me the taxable profits. Yes.
12.
The first year is 12. Wilson, give me for year 4.
83. Year 2.
83.
78. Year 3.
78.
1.
1.
1.
Okay. All right. Thank you. So after taxable profits, remember we are following the format. Immediately after your profit, you are supposed to pay tax. Examiner told us that tax is paid at 30% in arrears. Tax is paid at 30% in arrears, meaning that 1 year after. Okay, so if that is the case, the profit of year 1 of 12 million naira will be taxed in year 2. So what's 30% of 12?
3.6.
3.6. So let's say 4, rounding. What's 30% of 83?
24.9.
24.9, that's 25. 30% of 78.
23.
23.4.
23.4.
That's 23. What's 30% of 1? That's 0.3, right?
0.3, yes.
Okay, then. So if that is the case, the next item we are going to consider after this is our tax saved. Tax saved on capital allowance. Okay? On capital allowance, dash. Remember, your tax saved on capital allowance will follow the same pattern as your tax liability. So because our tax liability is in arrears, our tax saved on capital allowance must also be in arrears. So at this point, I need to go and calculate tax saved on capital allowance. You see the way we are picking it one by one. So you must ask the right question. I will move to working number 3. Working number 3, tax saved. I want to calculate tax saved on capital allowance. Okay. So I will create a column for here. The narration, the cost of the assets, then tax saved at company tax rate of 30%. Our figures are in million. Year 0, I will have the cost of the assets. I will go back to the question, what is the cost of this asset, of the equipment? We are told that the production equipment for the new device will cost 120 million naira. Okay, that's the cost of the asset, 120 million naira. Here is 120. Then year 1. In this question, would I go to where you have your capital allowance rates? In the last paragraph, you are told that capital allowance, that is tax allowable depreciation of 25% on reducing balance basis, could be claimed on the cost of the equipment. So I will then go ahead and do my working. So I have annual allowance at 25%. What's 25% of 120?
30.
30. 30 minus 120 will give me 90. This represents tax rated down value at the end of year 1. I'll move to year 2. Annual allowance at 25% of 90. What's 25% of 90? Yes.
23.
That is 225. 225.
Okay.
2.5. 23 approximately.
23, yeah, 23 minus 90 will give me 67. So tax rated down value at the end of year 2. I will move to year 3, annual allowance at 25%. What's 25% of 6? Pardon?
17.
17.
17.
Okay. Minus that will give me 50. Tax rated down value at the end of year 3. I'll move to year 4. Annual allowance at 25%. What's 25% of 50?
13.
13.
13.
Yes.
Okay, 13 minus 50 will give me 37. So this is tax rated down value at the end of, what's the useful life of the project? 4 years. Okay, we have gone beyond that. I thought it's 5 years. Okay, so if that is the case, we are going to stop at year 3. Remember, Annual allowance is an allowance claimable every year until the final disposal of the asset. So in year 4, this equipment will be disposed at what price?
10 million.
So scrap value is 10 million. Therefore, the difference between 10 million and 50 million tax written down value will give me 40. This 40 is called what?
Balancing charge.
That will be balancing allowance.
Sorry,
Remember,
balancing allowance. Yeah.
remember, when your tax written down value from the preceding year is greater than your sales proceed, it is balancing allowance. So at this point, I have two options to reduce my tax liability. I can either use capital allowance I've computed to reduce my tax liability, or I use tax saved on capital allowance to reduce my tax liability. Like I said, the format that we have, what we have in that format is the tax saved on capital allowance. Therefore, what's 30% of 30? That should be 9, isn't it? 30% of, so what's 30% of 23? 30% of 23,
7.
7. 30% of 17,
5.
5.
okay. 30% of 40,
12.
12. All right then. So somebody should add up the total tax saved. This is total tax saved.
33.
33.
Yes.
Total tax saved is 33. So I need to confirm so that I don't overclaim my capital allowance. I would then say total tax saved equal to the cost of the equipment minus the scrap value multiplied by company tax rates. So the cost of the equipment is 120 million minus scrap value of 10 multiplied by 30%. So this should give me the same thing as 33 million. So that means I've not overclaimed my capital allowance. So in that case, I need to go and post. I have 97512. 97512. 97512. This is working number 3. All right then. So immediately after your tax saved on capital allowance, we are going to have sales proceed or scrap value, which of course will occur at the final year, 10 million. Then we are going to have initial outlay. Initial outlay of the equipment is 120 million in brackets. Then we are told that there is an investment in working capital. So let's go back to the question and check our working capital.
That's 20 million.
20 million. So what's the
Yes.
nature? So we are told in the question that additional initial investment of 20 million naira will be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million naira when the production and sales cease. The average general inflation level. The average general level of inflation is expected to be 3% per year, and working capital would experience inflation at this level. What this means is that your working capital will grow by 3%. The working capital of 20 million will grow by 3%. So let us go and work out our working capital. Working number 4. Number 4, working capital. Okay, so I have year 1, year 2, year 3, year 4. Then I will have total. working capital. So, examiner has given us working capital of 20 million naira. I need to ask myself, examiner also told us that this working capital will increase by 3% per annum. So this working capital of 20 million naira, is it in current value terms or in year one prices? I need to ask myself before, because that will tell me how I'm going to inflate my working capital. You can see the 20 million naira given in the question. Examiner did not tell you is in current value price. So what I miss is that working capital of 20 million naira will occur in the first year. So if the working capital will occur in the first year, then of course you start inflating from the second year. Therefore, I will then say working capital at inflation rate of 3%. The first working capital is 20 million naira. Therefore, I need to multiply 1.03 multiplied by 20. What do you get? Yes. Are you still there? So here is 20.6. 20.6 multiplied by, hello?
Yes, sir,
Yes,
we can hear you.
Multiplied by 1.03 equal 21.2. Here is 21.2. 21.2 multiplied by 1.03 equal
21.9.
21.9. Here is 21.9. Okay, 21.9. You can see that our working capital has increased from 20 million naira to 21.9. So at this point, we are supposed to find the incremental working capital. Okay, the highest working capital is 21.9. You can't go beyond that as far as this working capital for this project is concerned. Therefore, I need to determine the incremental working capital. The first year working capital is 20 million. It has grown by 0.6. So I will say 0.6. So 20.6 minus 21.2. That should be 0.6, 0.6 again. Am I correct? 20.6 minus 21.2. So 21.2 minus 21.9, that should give me 0.7. So when you add everything together, it should give you 21.9. Is it 21.9? 20 plus 0.6 plus 0.6 plus 0.07. Is it up to 21.9?
Yes, sir. 21.9.
no.
Yes, sir.
Twenty.
21.1.
So at this point, so we need to, how do we then treat this working capital? Relevant year. Remember, in my previous explanation to you, we said that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Therefore, the working capital of the first year will be treated as cash outflow in year 0. The working capital of the second year, cash outflow in year 1. Working capital of the third year, cash outflow in year 2. Working capital of year 4, cash outflow in year 3. At the end of the useful life, you recover the entire working capital. So I would then need to go and post what we have done here. I would then go up there. Year 1 is 20. Year 1, we are treating it as cash outflow in year 0. Therefore, here is 20, 0.6, 0.6, 0.7. Then year 4 is 21.9 dash. This is working number 4. Okay. Then at this point, I need to find the net cash flow. Here is 140. So what's the net cash flow for? Here is 12.6. Here is, remember, this one is in brackets. Here is 11.7. So for year 2 and 3, year 2 to 3, what do you have?
Year 2 is
Year 2 is
88.6.
8.6.
8.6.
88.
88.6. Okay. Yep.
60.7. Next one.
50.7.
60.
60. Okay. 60.7.
The next one, 58.9.
Pardon?
58.9, the next one.
No. It can't be up to 58.
9.9.
You know,
Do it.
we have 21.9. Oh, sorry, there's an error. I did not put all of this in brackets. Sorry. You know, it's a cash outflow. Aha. So that means what we have done is wrong here. So let's recalculate. Yeah, do it again. This is 11.4.
11.4. The second one is 87.4. Or the third one is 87.4.
The third one,
Yeah, 87.4.
87.4. That's second year.
78.
The next one is 59.3.
59.3.
So,
Year 4.
Minus 28.9.
20.
Okay, wait. Is the year 4, is it intentional that you don't put it in bracket?
No, you don't put that one. That one is positive.
Okay.
21.9 is in positive.
Okay, please let me recalculate.
22 minus 15. That's 7. 7 minus that's 14. Or 13.1.
that's 14.9.
14.9.
14.9. So at this point, I need to discount my cash flow. I would then say discount factor at, I need to go back to the question. Am I given money cost of capital or real cost of capital? According to the question, you are told that Washington PLC has a real cost of capital of 7.8%. So since you are given a real cost of capital, you cannot use real cost of capital for money cash flow, because what you have before you arrive at this, your net cash flow, they are all money cash flow. You have converted real cash flow to money cash flow. So what that means is that you need to go ahead and calculate money cost of capital. Okay? We are given a real cost of capital of 7.8%. You need to convert that real cost of capital to money cost of capital. That will take us to working number 5. I will say money cost of capital. M. Using Fisher effect formula, M is calculated as 1 plus real cost of capital multiplied by 1 plus general inflation rate or -1. -1. So this is the formula for calculating money cost of capital. I would then say M equal to money real cost of capital is 7.8%. So that will be 1.078. The general inflation rate is 3%. So 1.03 or -1. My M will be equal to, bring your calculator and give me the final answer. 1.078 multiplied by 1.03 equal -1 equal multiplied by 100 equal, that's 11.034. 11.03%. Approximately, my money cost of capital is 11%. That's that. See the way we are flowing? That's where it is expected on the day of your exam. So my cost of capital to be used is 11%. Discount factor at year 0 is 1. So at 11%, give me discount factor. 1.11 raised to power 1 minus equal 0.901. 0.901. For year 2, 1.11 raised to power 2 minus equal 0.812. 0.812. Year 3, 11 raised to power 3 minus equal 0.731. Let me write that 3. Year 4, 1.11 raised to power 4 minus equal 0.659. Then year 5, 1.11 raised to power 5 minus equal 0.593. 0.593. This is working over 5. So at this point, I need to determine my present value. Here is 140 minus. Give me the present value. Year 1 to 5. Wilson, you can do year 5. Abu do year 4. Let me do year 2, then Debbie will do year 1. Year 2 is 87.4 multiplied by 0.812 equal
Year 5.
70.
Year 5. Okay.
Year 5 is what?
11.1.
That's 11 rounding.
Year 1
Yep.
is 10.
Year 1 is 10.
7.
Yes,
Okay.
approximately.
Okay. Abu, you are supposed to do year 4.
Year 4 is 43. Year
Okay.
3 is 43. Sorry, year 3 43.
3 is 43.
Okay. Year 4.
9. Let's say 10. Approximately.
10. So add up the positive present value. Here is the net present value.
145.
145 minus 140.
That's
5.
5.
That's 5. positive. Okay, so that's that. We just calculated net present value. Let's go ahead and calculate internal rate of return. However, you see, when you are done with the first calculation on the day of your exam, you need to review your calculation to be sure that what you have done is correct. You want to ensure that there is no mistake in your calculation. At times, you might have skipped something unintentionally, and that's why it is important for you to check the correctness of your number and be sure that what you have done is correct. So let me know if you have any question for me before we move to the second part of the question, which is internal rate of return. We have about 20 minutes more. So yeah, I'm listening. Any questions so far? So if there's no other question, so let's move on to the second part, which is internal rate of return. I'm trying to check the correctness of the number if what we got is okay. It's correct. All right. This answer of number year 5 is not correct. Who gave me that in year 5? 11.9 multiplied by 0.593 cannot be 11, huh? Debbie.
Yes, I didn't know it's multiplication. No, I learned from it.
No. It's multiplication, huh? So yeah, multiply again, 593.
6.94.
That's 7. No, this is what I was trying to say the other time. You know, when you feel like, on the day of your exam, that's too big. On the day of your exam, when you do the first addition or multiplication of your number, always try to check the correctness of your numbers, just to be sure that you are on the right path. You never can tell, maybe you have made a mistake during your calculate when you are using the calculator. So here is 7. So final answer will be what now? 17, that's 60. 70, that's 141. Difference of 1. Difference of 1, that's it. So number A2, we have to calculate internal rate of return. Let me use the second page. A2. Calculating internal rate of return. Remember, when you want to calculate internal rate of return, there are 3 procedures we are going to carry out. The first procedure is to assume 2 discount rates that will produce 2 opposing NPV, meaning that the first discount rate will give you a positive NPV, the second discount rate will give you a negative NPV. Then step 2, you calculate internal rate of return using the internal rate of return formula. Then step 3, of course, you make a decision. But in this case, examiner did not ask us to make a decision in this A requirement. So we only have to calculate IRR. Therefore, I want to calculate IRR. So I need to assume a discount rate that will give me a positive and negative NPV. Since I've calculated NPV before, I used 11% to calculate NPV and I got NPV of 1. You can see 1 is very close to 0. What that means is that the rate I'm going to assume should not be too far away from 11%, because the NPV of this one that gave us 1 is closer to 0. So we need a negative NPV. Therefore, the second discount rate we are going to assume should not be too far away. So if we assume anything from 13%, we should have a negative NPV. Therefore, I would then say assume 13%. Assume 13%. If we assume 13, and if 13% is positive, then we increase it to 15% to get a negative. So no issue. So here is 13%. If I like, I can change the format of my IRR calculation. I can use horizontal whatever, or I maintain the columnar format. Whichever one I do, I will still get the same thing. If I still want to maintain the columnar format, then I can then come here to say year 0, year 1, year 2, year 3, year 4, then year 5. So my net cash flow that I have up there is 140 million. What about year 1 net cash flow? Oh, you can't see it. Year 1 net cash flow is 11.4. 11.4. Year 2, 87.4. 87.4. Then year 3, 59.3. 59.3.
14.9.
14.9. Then year 5. Year 5 is 11.7. 11.7. So my discount factor, we're assuming 13%. So what's 13% of year 1? 1.13 raised to power 1 minus equal 0.885. 0.885. What about year 2? We have to finish the question. 1.13 raised to power. What do you have?
0.782.
1 point what? What did you say?
0.782.
0.782 or 3.
Yes, 3 for year 2.
Is it correct? 0.783?
Yes, for year 2. Year 2.
Okay. So I will then
Then
go
year
for year 4 will be 1.13 raised to power 4. Sorry, yes. 4 minus equal 613. 613. Then year 5. 1.13 raised to power 5 minus equal 543. So we need to get our present value. Here is 140 minus PV, then net present value. Your line is breaking. I can't hear you properly.
10.089.
10.089. That's 10. $11.7 multiplied by 0.543 equal 6.4. Okay. Here is 6.4, which is 6. 14.9.
58.43.
58 points.
68.43.
Here is 9. So this one is 68.43. Hello?
68.43.
Okay, that's 68.
The next one is 41.
41. So final answer. Final answer.
134.
134. 134 minus 140. That's minus 6.
Minus 6.
So if that is the case, I would please mute. I would then say internal rate of return equal to lower discount rates plus NPV of the lower discount rates divided by NPV of lower discount rate plus NPV of higher discount rates. All of this multiplied by higher minus lower discount rates. So IRR will then be equal to, we assume 11 and 13%. So 11 is lower. So 11 plus NPV of 11 is 1. NPV of 11, 1 plus NPV of higher, which is 6, multiplied by higher of 13 minus lower of 11. Final answer, IRR would then be equal to, I would then carry my calculator to say 1 divided by 7 equal, multiplied by 2 equal, plus 11 equal, that's 11.3%. My IRR is 11.3%. Approximately IRR is equal to 11%. Okay, that's that. Then finally, examiner also asks us to calculate discounted payback period. So I want to calculate discounted payback period A3. A3, calculating discounted payback period. Okay. Remember, the discounted payback period is calculated similar to the normal payback period. The only thing is that instead of using the cash inflow to recover the amount invested in the project, you are supposed to use the present value to recover the initial investment. So if that is the case, if I like, I can use the small table to get my discounted payback period. If I like, I can follow up with the columnar format. If I want to use the normal table, I will just say here, okay, cash flow. In this case, instead of me to put cash flow, I will not put cash flow because I want to use present value to reduce, to determine the payback period. I will then say PV, present value, then I will have balance. Therefore, year 0, we have 140, 140. Year 1, year 2, year 3, year 4, then year 5. Present value of year 1 equal to 11.4. No. Present value of year 1 is equal to 10. 1071.43. 1071.43. Year 4 and 5, present value 10 and 7. 10 and then 7. Therefore, 140 minus 10 will give me 130. 130 minus 71 will give me 61, I think. Let me confirm. It can't be 61. 130 minus 71. That's 59, rather. 59 minus 43 will give me 16. 16 minus 10 will give me 6. When you get to a point, when the outstanding balance is lower than the next cash inflow, then you put a dash. You can see 6 is lower than the next cash inflow of 7. Then you put a dash to calculate your payback period. So at this point, I can then say payback period equal to how many years have I recovered? I've recovered for 4 years. 1, 2, 3, 4. I would then say 4 plus the outstanding balance of 6 divided by the next cash inflow of 7, the next present value of 7. Therefore, my payback period is equal to 6 divided by 7. 6 divided by 7 equal, then plus 4 equal 4.86. Here is 4.86 years. That's my discounted payback period. That's my discounted payback period. So that's that. That's what the examiner is asking us. Number B requirements. On the basis of your NPV, and on the basis of NPV, advise if the project should be considered. Okay? Advise if the project should be considered. That's number B. I would then say number B. Examiner say we should use NPV to advise the company. I would then say the project is financially viable. The project is financially viable, considering the positive NPV of 1 million naira. Therefore, the project should be undertaken. The project should be undertaken or considered. The project should be considered. That's all. Now, whether you are asked or not, you are supposed to state your assumption. Even though in the question, examiner asks you to state your assumption. That's number C. What I'm now telling you is that whether you are asked or not, you must state your assumptions. So one thing is a given. Whenever you want to state your assumption, number C, I don't have space up there. That's what I want to write, number C here. So I would then say assumptions. Okay? Whenever you want to state your assumption, we are going to talk about cash flow. Cash flow is a given. You have to talk about cash flow. It's a given. Then number 2, if you are in a question, you are given cost of capital, then you have to talk about cost of capital. If in the question you have inflation, we talk about inflation. Then any other assumptions you have made in the question, you consider it. Okay? So in this question, we have sunk costs, which we ignore. So you talk about it. So what are you going to say under cash flow? You say it is assumed that the cash flow estimates are realistic and will occur at the end of each year. I repeat, under cash flow, you state that it is assumed that the cash flow estimates are realistic and will occur at the end of each year. You then say further that all the cash flow given, all the relevant cash flows have been inflated at the appropriate inflation rate. Then they move to number 2, cost of capital. It is assumed that the cost of capital of 11% is appropriate and consistent with the cash flows. I repeat, under cost of capital, the assumption is that the cost of capital of 11% is appropriate and consistent with the cash flow. We then move to inflation. It is assumed that the inflation rate will remain constant within the period under consideration. I repeat, it is assumed that the inflation rate will remain constant within the period under consideration, because if inflation rate increases, especially for the cash outflow, the decision to accept the project may not be possible. Then I would go to number 4, sunk cost. Under sunk cost, there are 2 cash flows that we ignore. One is for development costs, then the second one is for market survey. Let me confirm from the question. We have 8 million for developing and testing the device, which is development cost. We also have initial market research cost of 2.5 million. Therefore, in my assumption, I will say the cost incurred or the development cost of 8 million naira, the development cost of 8 million naira and market research cost of 2.5 million naira are sunk costs and therefore irrelevant to this calculation. That's all. No need to talk too much of grammars. All right. So that's the end of the question. That's the end of the question. So in our next class, by the grace of God, we have more illustrations. Okay, a bigger illustration for that matter. And that's it. Let me hear from you if you have any question for me so far, so that we can close the day. Any question?
Yes, sir, but I'll ask you privately. It's already past 11.
It's okay, no problem. Zainab, I did not hear your voice today. What happened? Zainab, are you still on?
Yes, I was giving you figures.
Yes, I know. I remember that voice.
Okay.
Yeah. So, any question for me, everyone? Okay. So, in the absence of
now, until we look at it.
It's okay. In the absence of no additional question, I want to say good night to everyone. I will see you again next week by the grace of God, when we shall continue the topic. However, Mr. Ashwaju will be having you on Friday by the grace of God. Good night to you all.
Good night,
Yes,
sir.
sir.
Bye-bye.
Thank you.
Good night, sir.
Bye.